Hey, what's up, everyone? Welcome to a capital hungry educational webinar on inflation. Will history repeat itself? Brought to you by Capital Hungry Market Research Group and being presented to you by Capital Hungry Analyst Sebastian. In this webinar, I'm going to be covering the topic of inflation in terms of historical repetition, doing a back test of the great inflation of the 70s and 80s, what the market's currently pricing in based on inflationary figures, and then what could happen in the near future? Could we see inflation make its way back? And that's something we're going to take a look at in more detail in this webinar. This is a great webinar to pair up with the Capital Hungry educational webinar, so make sure you've gone through all of those, and especially with the market update and educational webinar that Jeevan did last night. That was Sunday night, so weekly recap, market update, combination webinar, which ended up being educational webinar, which covered some of the topics that I'm going to go into more detail here. So without further ado, let's get started. So just to set the tone here on what we're going to cover in this webinar, inflation's second wave. Inflationary regimes are very volatile and can last for several years. Examples from history show similarities between the current inflationary regime and those of the past. As I go through the backtest of the 1970s and 80s great inflation, I want you to keep in mind the current inflationary cycle that we're in and how a lot of the fundamental catalysts and a lot of the impact that came from those fundamental catalysts is very similar to the impact that we're seeing now in the inflationary cycle that we're in now. And it just goes to show you what gets covered in the educational webinars and what Jeevan talks about as well, that these are all cyclical events that are basically programmed to happen just with different characters and in a different time period. But the market and inflation as a whole moves very similar to the way it has before. So just keep in mind the similarities between now and then when I'm doing the back test of the great inflation in the 70s and 80s, as it's pretty crazy to see the similarities between the two. So how the Federal Reserve reacts to this inflationary cycle will cement Powell's legacy either in a good way or a bad way. Only time will tell, but Powell's street cred is definitely on the line here. And from my view, as I'll go into some detail in that as well, he needs to cement his legacy in a good way for him. And we'll take a look at that and what that means for him. The market's reaction to inflation's volatility contradicts the Fed's message and actions. This is a very, very dangerous game to play. That market participants are trying to front run the Fed. Rule number one is you don't fight the Fed. And right now, the market's basically looking at at the situation like the Fed won't fight us. So the market's throwing punches at Powell and not expecting a counter punch back. So I think they're in for a rude awakening in the near future here. My theory, which has also been discussed in Capital Hungry and the educational webinars and discussions that we've had in the group in the chats, is that another inflationary boom is coming. With CPI, PPI, and PCE all being lagging inflation indicators, we need to look at coincident indicators to show us the true picture of what is really going on in the economy. So coincident indicators are basically looking at data that's showing you day-to-day fluctuations and not waiting for a lagging monthly report that shows you the previous month's impact on what's really going on. It's going to be interesting to look at that from the perspective of what's happened since the last CPI report that was showing you the picture of December. History also shows how different approaches to macroeconomic, geopolitical, and monetary policy factors can impact inflation. So, how the Feds react to these will implicate the future of the economy and their fight against inflation. So, now we're going to talk a little bit about the great inflation from the 1960s, 70s, and early 80s. The great inflation was a defining macroeconomic period of the second half of the 20th century. Lasting from 1965 to 1982, it led economists to rethink the policies of the Fed and other central banks. The origins of the Great Inflation were policies that allowed for an excessive growth in the supply of money, which are Federal Reserve policies. This is something that gets discussed in detail in the market update webinar yesterday, in any of the CH educational webinars when we talk about inflation. The origins of inflation are based on the growth of the money supply. So the Great Inflation was also caused because of excessive growth in that. So just take a look at that chart there. Gives you a good picture of how long that inflationary cycle lasted and the volatility that it had. Like, look, it goes up to 6%, comes back down into the 4% range, picks up momentum, breaks above 10%, comes back down to 5%, comes back with full fury momentum, and goes basically to 15% before Volcker really tightened financial conditions and hiked the shit out of interest rates to really crash the market, cause two recessions, increase unemployment, and bring inflation back down to that 2% range. But that's what I want you guys to keep in mind, that the markets are basically disregarding the volatility that inflation can have and how long inflationary cycles can last. This lasted almost 2 decades. So the motive for this little story of the Great Inflation, very similar to the motive of inflation today: the pursuit of maximum employment. The first part of the story, the motive underlying the Great Inflation, dates back to the aftermath of the Great Depression, an earlier and equal transformative period for macroeconomic theory and policy. The Employment Act of 1946, among other things, declared it a responsibility of the federal government to promote maximum employment, production, and purchasing power, and provided for greater coordination between fiscal and monetary policies. So if you take a look at those two statements, this was all derived from a crisis, the Great Depression. Current inflationary cycle we're in right now, derived from a crisis, which was the COVID pandemic. So the trade-off between lower unemployment and more inflation that policymakers may have wanted to pursue would likely be a false bargain, which required even higher inflation to maintain. So in order to maintain maximum employment, that required letting inflation go for a bit of a run. But we know that that didn't work out in their favor, and we're seeing that as well now. Promoting maximum employment and chasing maximum employment like the Fed did all through the second half of 2020, all of 2021, was what gave inflation the grounds to really take off. The means. The story of the Great Inflation is in part also about the collapse of the Bretton Woods system and the separation of the US dollar from its last link to gold. If you go back and watch the dollar domination webinar that I did previously, I go into a little bit more detail about the Bretton Woods Agreement and what that meant for the US dollar and how it basically broke its link to gold, and also how the US gained world reserve currency status after that. With the last link to gold severed, most of the world's currencies, including the US dollar, were now completely unanchored. This was the first time in history that most of the monies of the industrialized world were on an irredeemable paper money standard, the fiat standard. Fiat comes from the Latin word which means determination by authority. After World War II, when the US came in and cleaned up, and then they severed their ties to gold after the Bretton Woods system, they gained world reserve currency status in the fiat standard with authority, with their military prowess. So you can see there how that's all derived into what we're seeing with the US dollar as a world reserve currency into the fiat standard. As the world's reserve currency, the US dollar had an additional problem. As global trade grew, so too the demand for US dollar reserves. For a time, the demand for US dollars was satisfied by an increasing balance of payments shortfall and foreign central banks accumulated more and more dollar reserves. The opportunity, this is very similar to what's going on now. These are very, very almost carbon copy similarities to the current inflationary cycle. So the opportunity, fiscal imbalances, energy shortages, and bad data also gave breeding grounds for inflation to take off. In the late 1960s and the early 1970s were turbulent times for the US economy. President Johnson's Great Society legislation brought about major spending programs across a broad array of social initiatives at a time when the US fiscal situation was already being strained by the Vietnam War. These growing fiscal imbalances complicated monetary policy. You can basically take this statement and switch it out to present time. So let's say from 2020 to 2023 were turbulent times for the US economy. President Biden's Build Back Better legislation brought about major spending programs across a broad array of social initiatives at a time when the US fiscal situation was already being strained by the Russia and Ukraine war. These growing fiscal imbalances complicated monetary policy. A more disruptive force was the repeated energy crises that increased oil costs and sapped US growth. The first crisis was an Arab oil embargo. During this period, crude oil prices quadrupled. The second oil crisis in 1979 tripled the cost of oil. Energy crisis is another thing that's very apparent in present times as well. Inflation could also be pushed higher by supply disruptions. What did we hear all through 2021? Supply chain imbalances, supply disruptions, supply driven inflation. Same thing happened then in the Great Inflation. So inflation could also be pushed higher by supply disruptions, notably originating in food and energy markets. This cost push inflation also got passed through the chain of production into higher retail prices. It's exactly the same thing that's happening now. Motivated by a mandate to create full employment with little or no anchor for the management of reserves, the Federal Reserve accommodated large and rising fiscal imbalances and leaned against the headwinds produced by energy costs. These policies accelerated the expansion of the money supply and raised overall prices without reducing unemployment. Bad data, or at least bad understanding of the data, also handicapped policymakers. Looking back at the information policymakers had in hand during the period leading up to and during the Great Inflation, economists have shown that the real time estimate of potential output was significantly overstated. And the estimate of the rate of unemployment, consistent with full employment, was significantly understated. So, if you're looking at this statement, if you go back and read Nalab's economic reports, where he really digs into the economic report and the data and shows you how a lot of this information that gets put out into the media, when you uncover it and you look under the hood, a lot of things are being overstated. There's a good report that he did on GDP growth where it showed that the US economy was growing, but only in one sector, not as an overall economy. Same thing with the employment reports. When you look at NFP printing solid numbers, but you dig into it and you look at the establishment or the household survey versus the establishment survey, the household survey gives you a clear picture of what's really going on. But that's not what's being pushed to the masses and to the media to keep people at bay and not questioning what's really going on in the economy. Same thing happened back then in the 70s. Bad economic data being shown in a different light really handcuffed policymakers to make the right decisions at that time. So, how did they end the Great Inflation? The Great Inflation lasted for almost 2 decades. It went through two Fed chairs who both had different approaches to monetary policy and tackling inflation. Fed Chair Arthur Burns focused on non monetary policy factors and kept rates low amid rising inflation. He's also known for his stop and go policy adjustments, where interest rates would spike briefly, then he would cut them briefly, and then he would spike them again. Inflation would fall, but would come back with even more momentum each time and ultimately ran away on him. He's He's known as the worst Fed chair for those decisions that he made back then. Fed Chair Paul Volcker from 1983 focused more on monetary policy factors affecting inflation, and kept rates relatively high. Even as inflation declined, he kept the rates high. He caused two recessions and unemployment to increase to 11%, but he was finally able to tame inflation and bring it back down to the 3% range. If you look at these two Fed chairs and decisions that they made, I've always said that the last 4 years has been like a 50 to 100 year economic cycle, like condensed into like a small 4 year time frame, because we've had so much happen over the last 4 years. And even if you look at how Powell handled the situation, you can see a little bit of Burns, a little bit of Volcker, and I think now he needs to have like his real Volcker moment if inflation starts to make its way back up. But you can see that they both had different approaches, and the final approach is what the Fed has been leaning more towards, which is keeping rates relatively high even as inflation declines. They've said many times that they're not thinking of loosening policy until inflation is well below into the range. So like well below 3% into the 2% range, because you saw in the chart from the great inflation that even when it came back to 3%, it gained momentum and went back up to 10% right after. So let's bring this back to where we are now. The market's reaction to inflation's volatility contradicts the Fed's message and actions. This is a dangerous game that market participants are playing. The market has priced in a 25 basis point hike for the meeting this week, but the question will be, if it's 25 basis point, what is Powell's tone going to be during his speech? Because 25 basis points is slowing down the pace of rates, as they did an aggressive front load last year and then they downshifted to 50% in December. So if they downshift to 25, what's his tone going to be? Is he going to do a 25 basis point hike but then come out extremely hawkish? Or is he going to be dovish, neutral Powell and continue to feed the rally? Powell has been quite consistent in his higher for longer messaging, meaning holding rates higher for longer, and has been transparent with his forward guidance. He has not dropped any surprises at FOMC besides changing his tone to soothe or drive through the markets. And I sent that chart, and I think it was in Banter over the weekend, of how he would make certain comments at certain times, depending on where the market was. Powell's well attuned with the market. So anytime the market would price in a 50 basis point rate hike or the next rate hike, you'd see some aggressive downside leading into the meeting. And then he would come in the meeting and soothe the market by having some more neutral to dovish comments, which would prevent the market from continuing to move down with so much conviction. It would, like, some of those bounces were like 3% bounces or 4% bounces on US 30 or the stock market after his speech. Obviously, the market was going to continue to price in the continuous tightening cycle and rate hikes because that's what was moving the market. But his tone from the FOMCs would take out some of the conviction that the market was driving down with. Like anytime the market was printing a new low leading into FOMC, he would soothe the market. If he would come out, like when they did the 75 basis point hike in June after the May inflation report was high, if the market was at lows, if he would have come out and said, yeah, we're going to do 75 basis point hikes for the next two meetings, the market would have crashed. Instead, that was the first 75 basis point rate hike. Instead, he said 75 basis point hikes are not something we're going to look at doing continuously, or it's not going to become the norm. And then they did three more right after. So you can see how he uses his tone and his wording to soothe or drive through the markets, because right after that, when he said 75 basis point is not going to be the norm, that's when the market did that summer rally from June basically till August. So when the market was now at a high price point like it is now, primed, and basically him controlling the stability, the price stability of the market at Jackson Hole in August, was when he came out extremely hawkish just to drive the market back down. So the amount of power that he has with his words is absolutely insane. And market participants are breaking rule number one: don't fight the Fed. Market participants are front running a full Fed pivot, and they're predicting that the Fed will cut rates into the second half of this year, 2023, which for me is a little bit insane because the Feds have not given any hints as to doing that. The market's just basically anticipating saying, you should do this because we feel like you should do this, which is how we came up with like the pivot prayer narrative, because it's just the market moving on hopes of what the Fed's going to do, but the Fed has been pretty clear on what they wanted to do, and they've been pretty transparent with that as well. And they've stayed the course. They haven't faltered from what they said they were going to do. It's just that Jerome Powell uses his tone to to create a little bit of that confusion in the markets to not have like one-sided volatility one way or the other. When we look at the tightening cycle by the Fed, it's broken down into three stages. So, stage number one, were rapid rate hikes to get to neutral. Stage number one, with the rapid rate hikes and the aggressive front load of like 50 basis point, then 475 basis point hikes, and back to another 50. You have to remember that these were coming from rates being at 0.25%. So they stated clearly that they wanted to get to neutral as fast as possible, and they achieved that last year in 2022 with the most aggressive front load seen in modern times. Now, stage number two, which we've had Powell state, I think it was in November, where he said, now that now that the rate is at neutral, it's time to look at having more. It's not about the pace, but it's about the consistency of hikes. So now they're looking at taking more measured hikes to get to sufficiently restrictive, which when you look at their terminal rate predictions, I think Bullard also shared his PowerPoint on what they look at for sufficiently restrictive, and it's anywhere between like 5 to 6%. But they even said that the terminal rate could change depending on data, so they can continue to increase the terminal rate. Doesn't mean that they're going to keep going with aggressive rate hikes like 75s or 50s, because that's pretty aggressive at where the rate is actually at now. Like it's at 4.5, 4.75. So now it's about using more measured hikes and continuing to hike until they get to sufficiently restrictive, which is going to be an ongoing process. The third stage of the tightening cycle is staying at the terminal rate for some time, which is the next stage. This third stage is the stage that the market participants are completely dismissing. This is where they're going. The final act is the actual pivot from a restrictive monetary policy to a stimulating monetary policy, which includes rate cuts. I don't think this is going to happen into 2024. In their dot plot, they don't even see rate hikes until the second half of 2024. On many occasions, Powell has said that the policy rate is merely a tool and that the Fed's aim is to create sufficiently restrictive financial conditions. He's also warned many, many, many times against loosening prematurely and has made it a clear message. He knows what happened in the great inflation of the 70s and 80s. He knows what mistakes Burns made. He knows what Volcker had to do. He's studied all this. He knows how inflation can come back. They've stated it. I think he stated it in January that the inflationary pressures are still a risk to the upside. So he knows what's happening, and he's been pretty clear with that messaging of not wanting to loosen policy prematurely. So, with consecutive months of cooling inflation reflected on the CPI, PPI, PCE, plus a downshift to a 50 basis point hike in December, and Powell saying that slowing the pace of rates is probable, the markets are pricing in a 99% probability of a 25 basis point rate hike for the February meeting. The market's completely discounting a 50 basis point hike. It's 98.4% for a 25 basis point and 1.6% for a no hike. So the market's completely dismissing like a super aggressive Powell. But I think he can really set the tone with how he talks in his speech, even if they just do a 25 basis point hike. You can see here inflation peaked around June, which was when they started doing the 75 basis point hikes, and then it's completely started to make its way down. But as we've seen before, the volatility and inflation is it can just come right back. They're still their goal is 2%. 6.5 is still more than 3 times higher than their goal. It's not like inflation's down at 2% or down at 3% where it's close to their goal. It's still 3 times above that. It's still basically where it was at the start of 2022. So don't fight the Fed. Powell has been very consistent with his forward guidance and his higher for longer mantra. This aligns with their dot plot predictions and their terminal rate predictions that were released in November. Market participants are playing a dangerous game front running a full Fed pivot into cutting rates by year end. You can see here that market participants are pricing in rate cuts starting from like the July meeting, which is a bit ridiculous as inflation can come back. My prediction, and Jeeves discussed this as well, inflation is going to start to tick back up and show the true volatility and the upside risk to it is going to be in like April and March, or March and April, when you start to see like the beginning of this year and how that plays out, and those reports show the inflationary pressures coming back. There's a lot of different factors that are going to support my thesis of inflation coming back. You can see here how clear Powell has been with his messaging, and he knows what happened back in the 70s and 80s, and he doesn't want to repeat that. Historical record cautions strongly against premature loosening. He said that in December. He said that in November. He said that earlier in November. This was Brookings. This was FOMC. This was FOMC. This was FOMC as well. This was Jackson Hole. This was FOMC. He's been very clear about not wanting to make the same mistakes that Burns did and loosening policy prematurely. And then something here that he said in December: financial conditions fluctuate in short term, but important that over time they reflect policy restraint. So as retail day traders, we get so caught up in like what's happening day to day, week to week. We have to remember that Powell, the Fed, they're looking at a long-term picture. So Powell could be looking at an inflationary cycle that can last 5, 8, 10 years. So he's thinking, yeah, obviously financial conditions are going to fluctuate from loosening to tightening, but overall, in the grand scheme of things, financial conditions need to reflect policy restraint over time. So being able to bring inflation down into that range and keeping it there. Now we're going to talk a little bit about Powell's street cred and what I think, again, from a psychological standpoint, what he is trying to achieve and how he's going to be remembered. I mean, someone with as much power as Jerome Powell, who has basically the global financial markets resting on his shoulders, that's a big, big, big task to have. That's a lot of pressure on one man. So one man to have that much power wants to leave a legacy. He doesn't want to be remembered in the wrong light. So for me, Powell wants to also cement his legacy. He doesn't want to be known as the second Fed chair that let inflation get away from him. So Paul Volcker, obviously we all know he's remembered as the Fed chair who brought down inflation in the 70s and 80s. Alan Greenspan, who's known as the Fed chair that blew massive asset bubbles and benefited the 1%. Those were two Fed chairs that are remembered in such a good light because of what they did for the economy. Bernanke, he's known as Helicopter Ben, and he actually coined that term himself when he was calling stimulus basically helicopter money. It's like dropping money out of a helicopter. So he's known as Helicopter Ben because of the GFC debacle. Arthur Burns, the Fed chair from the 70s, is revered as one of the worst Fed chairs for allowing an inflationary cycle to go on for so long and for the stop and go approach that he had towards monetary policy, which basically fueled the fire for inflation. So you can see these are four Fed chairs, two remembered in a good light, two remembered in a bad light, and there has been many, many, many Fed chairs in between all of this that are not even remembered. It's what you do in times of crisis which you're remembered for. So if you think of like what Powell wants to do and how he wants to cement his legacy, he doesn't want to be remembered as the one that fucked it up. So from my perspective, Powell wants to have his Volcker moment too, but I think Powell also has a little bit of Greenspan in him where he's always wanting to benefit the 1%. So we'll see how this all plays out in the long run. But yeah, Powell needs to cement his legacy and how he's going to be remembered as the Fed chair through this time. He doesn't want to be remembered like this guy, the worst Fed chair, Arthur Burns. I'm actually reading a book, or I read a book from a Fed insider, and she talks about how at the Federal Reserve building they have like the headshots of all the Federal Reserve chairs in a hallway. And she said that even the janitor knows who the worst Fed chair was, which is Arthur Burns. He's been known as that since that inflationary cycle of the 70s, which you can see here, like what he did in the stop and go approach, how that was just feeding fuel to the fire of inflation. But something else I wanted to look at is if we highlight like this section here is very similar to where we are now in the inflationary cycle. So broke out of the 2% range. Inflation, I think, was like what 9.9 in June. So we're just in this area here. Same thing. See some pretty aggressive deflation over 6 months, like we did over the last 6 months. Came down into like we're at 6.5 now, so let's call it here. But loosening policy prematurely basically led for inflation to have this momentum and continue to go up. And then like this next upside was the one that went up to like 15%. So it's very clear to see how the volatility in an inflationary cycle comes in. Like inflation was pretty bullish. We didn't even get a double bottom. It just printed a new uh a new higher low income. Going to optimal entry for inflation right here. But yeah, you can see the volatility of inflation, what Burns policy decisions did and how that fueled the fire for inflation and how long an inflationary cycle can last. Like inflation is not like market participants are thinking that inflation is going to do this. So okay, it went up and now it's just going to come back down. It's not that easy. It's not going to happen that way. So why is it not going to happen that way? Will inflation tick back up? The reason why front running a full Fed pivot is dangerous is that market participants are ignoring the volatility of inflation. We've seen very few instances of transitory inflation in prior inflationary periods. Do you remember how long they went on with the transitory phrase of inflation being transitory? You don't see that in inflationary cycles. You don't see transitory inflation. Right? Like transitory inflation is just when you get like small spikes of inflation up to like the 3% range and then they come back down to 2%. When you break above like 4 or 5%, it's not transitory. It's just going to have momentum and it's going to take a lot to bring it back down. Inflationary periods can last for years and have massive volatility, so you can see how long some of these inflationary cycles lasted. Like this one in the 40s. This was the one 60s. Oh, this one 40s, so like around World War times. Then this is the one we just covered, the Great Inflation. And then we're in this one now. But you can see like we're talking 5, 10, 15, almost 20 years that inflationary cycles last. So that's why I wanted to highlight this headline here from IMF in April 2022, where Powell said he made a comment about we might be in for a world of higher inflation. So he is basically preparing, or he is prepared to see a full inflationary cycle play out. Market participants are thinking that this shit's going to go up and come back down. He knows because of having research on history and previous inflationary cycles that it's not as easy as it just going up and down. It can be a long period of time. So I wanted to highlight that headline because it almost felt like at that time he was basically preparing for what could be a long drawn out fight with inflation. So, what can cause inflation to tick back up? When wage inflation and services inflation become entrenched in the system, the base level of inflation becomes higher. So, what does that mean? Like, as people continue to pay for goods and pay for services at a higher price, those prices become entrenched and become the norm in the economy. So, with a higher base, the price of goods works against you again. So, the more you pay for high price groceries or high price items, the more those prices can become entrenched. And then those prices become the norm. Then wages adjust to those prices. And then those prices just stick. And that becomes sticky inflation. If you look at gasoline here, which was deflationary over the past 6 months, now it's up 13% in the last month. So now we're looking at some coincident indicators of what's really been going on over the last month, because we're not going to get that information until the CPI report comes out. So if this continues to trend up, we can see some higher CPI reports come March and April, because we got that bounce here from $2 a gallon, and now it's starting to make its way back up. So this was the deflationary period over the last 6 months. Obviously, Biden draining the SPR had something to do with that. But again, everything deflated over the last 6 months, and now it found a base, and you can see the volatility and inflation, right? It's starting to tick back up. So gasoline is up 13% in the last month. Take a look at services inflation, housing and utilities. It's all going up. They're expecting housing to roll over, but the real estate market's starting to find a base again, and it's also picking up. Talking to somebody in CH whose brother is a real estate broker, it basically said to him that the market is back even during the slow season. So that just goes to show you, like, to quote my boy Alan Greenspan, when the market is exhibiting irrational exuberance is when you know that something's about to turn for the worse. So looking at the PC deflator here, looking at how the increase in inflation keeps going, nothing has really turned. We have oil, which failed to break below $70 a barrel, starting to get a bit of a bounce here and starting to tick back up. Some of the factors that are going to impact the price of oil is China reopening. I read a stat that the reopening of China can add 1.5 million barrels per day of demand for oil, because I mean China's been locked up for 3 years, and the reopening hasn't been fully priced in yet. Like this is just starting to happen now. So we'll have to see how oil starts to play with that. And the China reopening is such an inflationary factor, because that's so much pent up demand that's going to come into like the Western world when the Chinese start traveling and wanting to spend all that money that they've been saving for the last 3 years, because their lockdowns weren't like our lockdowns. They had like draconian lockdowns where they were getting basically welded shut into their apartment buildings. So there's so much that's going to come, so much inflationary pressure that's going to come from the China reopening that no one's really accounting for. Geopolitical tensions can obviously have an impact on oil prices as well. We can see here this real estate chart. Real estate's getting a bounce after the initial rate hike downside. So we had that. Oh, let me go back to that. There's my box. We had that deflation from the initial pricing in and feeling of the rate hike cycle, which, if you look at, I did another webinar on how monetary policy works its way through the economy. You can see that the real estate market always feels it first. So they had that initial downside first, felt like the market was crashing, but the market found a base, and now it's starting to rebound. It started to rebound around the same time that we started to ride the Fed pivot prayer narrative and sentiment. So you can see real estate markets having a bit of a recovery here, which again leads into inflationary pressures, as housing is such a big part of the inflation readings. Commodities are booming. So copper versus CPI here. You can see copper tends to precede or lead CPI by about 3 months. So if we look, I mean, here is like GFC. So copper dropped first, then CPI dropped, Copper went up first, then CPI went up. Look here, copper went up first, then CPI went up. Copper dropped first, then CPI dropped. So what are my expectations for CPI here? Would be something like this. Maybe it comes down to like 5.55 with the next, like with the January reading, because we're not going to see the impact of these inflationary coincident indicators continuing to go up until like March or April. So maybe we get a little bit more of relief on the next report, and then boom, like this is what I'm expecting to see here on copper and CPI. Well, on CPI. So real interesting chart to look at there, commodities and how they precede CPI and CPI fluctuations. Take a look at gasoline versus CPI. So gas goes down, CPI goes down. Gas goes up, CPI goes up with it. Look at that, CPI is down, but gas went up in the last month. So what are we expecting to see? We get another green candle there. And then we start to see something like this again, right? So these are some coincident indicators that I've been looking at just to give me a gauge of like what's really going on in the economy and not waiting for that lagging data to paint the picture for you. Obviously, like I'm not trading any of these commodities or anything like that, but I like to get a gauge for what's really going on because you need to be prepared for things to happen. And then it just gives me a bit of a better understanding of how the Feds will end up having to react because the markets are pricing in basically a new bull market. Like that's pretty far out of the question in my view. I think the second leg down for the market is coming, especially once inflation starts to tick back up. So tying this all back to current sentiment, what this could mean for the FOMC meeting, what this could mean for future FOMC meetings. I mean, this could still be a bit early. We could still get a neutral to dovish Powell at the next meeting, which would feed the rally a little bit more. But I think come March and April, you're going to really get to see a clear picture of how the big flip is coming. Like inflation is going to go up, and then you're going to get that second leg down in the market. Dollar domination come back as the Feds maintain their hawkish approach because they need to tackle inflation. So tying this all back to the state of the economy. So what can happen? If the labor market remains tight, which it has, unemployment rate dropped last month. It's like at super record low levels, 3.5%, is it? As long as jobless claims remain in the lower bounds, so anything below 300,000 per week is not anything crazy. The stock market remains stable, which is really what Jerome Powell is doing. His balancing act is price stability in the stock market. Like Jeev said in the webinar, the soft landing is not for the consumer. The soft landing is for the stock market and investors and big banks. As long as inflation remains well above 3 to 4% or prints higher than the previous month, and as long as inflation risk and the coincident indicators that I showed you before, as long as those risks remain to the upside, bringing inflationary pressures back, I'm expecting that the Fed are going to continue with their hawkish approach, continuing to hike rates. Maybe they don't go 50, 75, but they keep doing consistent 25, 25, 25. The only reason, and I mean, this is just personal opinion, the only reason why I don't see them downshift into 25, I mean, you never know. Like Powell could come in on Wednesday and drop a 50 and say, fuck all y'all, and just mic drop it. But if they do downshift to 25, I think they have to stick to 25 because then it would really hurt their credibility if they did 25 and then all of a sudden they were like, oh shit, we got to do 75 again. Because then the markets are going to be like, well, why did you downshift to 25 in the first place? So, I mean, they could be making another policy mistake, which they have made a few already, whether it's premeditated or not, where they know what they say they didn't see inflation coming, but that's all bullshit because they know that their policy decisions can fuel inflation. So my view is that they do a 25 on Wednesday. Maybe he becomes a bit more hawkish and squashes the narrative that the market's pricing in rate cuts, and he's going to continue to hammer down that higher for longer mantra for policy, which from my perspective, this is what the market is not pricing in right now. They're not pricing in the Feds holding the rates this high or going higher and holding them there for an extended period of time. The market thinks that they're going to hike to terminal rate and then cut. I didn't like whether they cut as the economy goes into a recession or not. We'll have to wait and see. But again, the market's just banking on these things, and the market's throwing jabs at Powell, basically running away with these bear market rallies or these rallies and not expecting him to come out with a counterpunch at FOMC. So, because again, like super loose financial conditions are just going to feed into inflation as well. So that's a bit of a little back test, history, inflation, what that means for the current inflationary cycle, what we can see playing out, some of the data that you can look at to get a better picture of what's really going on in the economy at the present moment. And yeah, that's it. That's a little bit of a educational webinar. Pair this up with the market update from yesterday, January 29th, the weekly recap market update that Jeevan did. This goes well as well with dollar domination webinar. A lot of the capital hungry educational webinars on inflation, FOMC prep webinars. Anything you want to tie it together with will be very beneficial to your own development as a trader and understanding of these vicious global financial markets. And yeah, rule number 1, don't fight the Fed, because you know Jerome's got hands, and we'll see those hands on Wednesday, hopefully. All right, any feedback or any comments, just hit me on the DM or in one of the chats. Take it easy, guys.